on the show, the following would happen. The Bank of England would come in and say we got to lower rates. That's right. The cycle is complete. There are social problems. There is social unrest. There's a crisis. It could be Brexit. It could be bombers in Istanbul. There's always a crisis. This is followed by a rate cut, which increases the wealth and income gap, which then increases the social cohesion risk. And the whole frickin' cycle goes again and again and again. Bruno, over there, I want you to zoom in on this just to show the people once again that I've been completely accurate in my prognostication. Look at that. Bruno, zoom in on that. Here's Mark Carney. Here's the devil himself coming into the public domain saying, we're going to cut rates at the Bank of England. As I predicted they would. Of course they got to cut rates, because every time they make a freaking mistake, they cover it over with more rate cuts, more free money, more money printing. They don't take responsibility. The politicians are out there leaving the ship. They're jumping ship. They just leave this guy to print money. That's not economics. That's not politics. That's tyranny.
The L word is back in fashion. Liquidity crisis. The Italian banks asked for bank liquidity support after Brexit vote late last week. And so,
to put that into context, you go back to the 2008 crisis, nobody would say that the banks are insolvent.
No.
They just said they had a liquidity problem.
Yes.
So they asked all the central banks, the IMF, World Bank, print, to cover their liquidity crisis. What did they do with the liquidity that was printed? They went out there and they bought speculative assets like art, London property, and bonds, and they drove the prices up, and they created a wealth and income gap, and then they created more social unrest. Whether it's a Brexit vote or bombing in Istanbul, it's the central bank's fault.
Prior to the 2007-2008 financial crisis, it was the American banks which had a lot of toxic debt on their books. That is mostly gone. It's perhaps on the Fed's balance sheet, but European banks still have a lot of dodgy stuff there. And the worst of them all, Deutsche Bank poses the greatest risk to the global financial system. This comes from the IMF, and they note that there's $72 trillion worth of derivatives, notional, on Deutsche Bank's balance sheets. And they failed the Fed's stress test last week for the second time.
This is liquidity. Here's liquidity, right? Here's liquidity. I'm supposed to drink this to create a healthy ecosystem in my body. Here's what they do. They just pour it on the floor.
Honey.
They pour it on the floor like that. It doesn't go where it's supposed to go. That's because they're working for the cronies. They're not actually conducting any coherent economic policy.
I'm going to read to you. It goes like this. Not only did Deutsche Bank just flunk the Fed's stress test for the second year in a row, but moments ago, in a far more damning analysis, none other than the IMF disclosed that Deutsche Bank poses the greatest systemic risk to the global financial system, explicitly stating that the German bank, quote, appears to be the most important net contributor. This is the systemic risk among GSIBs, which is globally systemic important banks. Right there in the middle of it all is Deutsche Bank, and all banks lead to that.
Look, let me explain something about Deutsche Bank. We've been saying on this show for months now that they are the most at-risk bank in the world. They have a derivatives book of over $100 trillion. That's all insolvent. Nobody wants those derivatives. The bank is technically insolvent. They're kept aloft from ECB and other global central banks conducting collusionary activities to mask the fact that this bank is the next Lehman Brothers. When this bank goes down, the 2008 crisis will look like a picnic. This is the beginning of the big enchilada, the big global crisis that will set off the global insurrection against banker occupation. All these disparate groups in Europe, in the United States, in Latin America will join forces, and the global revolution will be on. There'll be pitchforks, there'll be bonfires, there'll be lots of crazy stuff going on, but it's a necessary corrective. We need to come back to something like gold, and this is the way we get there.
You look like a crazy man with all that liquidity on your face.
I got liquidity. I'm Mario Draghi, and I've got liquidity. But I'm not putting it where it's supposed to go.
So, well, you mentioned Lehman Brothers, so I'll show you this chart. This is an updated chart. You and I have covered this chart before. This is Deutsche Bank, and this is Lehman Brothers shares down here. This is when it went finally bankrupt. As you see, Deutsche Bank has been following religiously this Lehman Brothers collapse. So Deutsche Bank is the most systemic risk posed by Deutsche Bank. Number two, the IMF says, is HSBC. Number three is Credit Suisse. So the European banks. Number four is JP Morgan. Five is Goldman Sachs. So it's over in Europe. This Brexit situation has caused well, it hasn't caused the problem, obviously. All their bad debts have caused the problem, and negative interest rates from the ECB and around the world have caused this problem. But here we have perhaps a black swan.
2008 was a banking crisis.
Yes.
Okay, banks like Lehman Brothers and around the world, they had a liquidity crisis, they had a credit crunch. And these central banks came in. But the central banks took on, up by some estimates, $20 trillion worth of bogus paper. Now we're having a sovereign bank crisis. So there's nobody behind the sovereign banks to bail out the sovereign banks. However, if you do accept one idea, which is, I think, somewhat plausible, is that the IMF, the International Monetary Fund, has something called a special drawing right, which becomes a global currency. They create a $100 trillion credit facility, and they roll up all these sovereigns into a new global credit facility backed by special drawing rights. That's why China has been working hard to get into that basket, into the special drawing right. As a hedge against not getting there, they've been buying gold, same thing with Russia. So all these major economies are preparing for a global financial Armageddon by buying gold, lobbying for special drawing rights, and as we see with Deutsche Bank, the end is nigh. When this bank goes under, that's basically the end of globalization, as it's been described. For the past 20 years, it's finished.
China has been devaluing their currency, which is a part of that end of globalization, part of the Great Depression.
It's a circular firing squad.
It's a circular
of currency devaluations around the world.
And I also mentioned in Toronto that I thought that all these Chinese citizens were, taking out loans in China, ready for this collapse of the fiat system, buying assets up around the world. And I saw that CIBC Bank, the biggest bank in China, is chasing people in Vancouver now who took out, just like I suggested, $10 million worth of loans that they had no intention of paying back in China, and they've been buying up assets in Manhattan, Vancouver, Toronto, everywhere else.
The Chinese buyers of these properties in Vancouver, the government is now going after them.
Yeah.
And this is where they have parked their money overseas to essentially launder that money, because in the local crackdown on corruption in China, if you can get 50 cents on the dollar by buying an overpriced property in Vancouver, it's better than 0 cents on the dollar. But how long before Chinese hit squads start arriving in Vancouver to take out these guys?
Because there's no government that's going to give it back in a situation.
China assassinates bad actors.
Okay,
they don't like go in front of a congressional committee and play footsie. They send over a hit squad. Okay, how long before the Chinese hit squads hit Vancouver to take out these real estate speculators?
But it's very unlikely that Germany or the UK or the US is going to want to give up Tier 1 capital represented in these properties and the stolen cash.
Now, speaking of Tier 1 capital, Moody's, S&P, and Fitch downgraded Britain, no longer AAA rated, but that's the foundation upon which this global Ponzi scheme is constructed. But now the foundation blocks are being removed as all these AAA rating credits are being dispensed with because of this currency race to the bottom. As the Economist calls it, social cohesion risk, which is a nice way to say riots.
Italy eyes €40 billion bank rescue as first Brexit domino falls.
Right. You don't know what snowflake is going to set the avalanche in motion.
Yeah.
But it's going to happen, and so Brexit, they can make that the excuse. Greece was a $200 billion economy that the hedge funds, John Paulson and others, destroyed to make a quick buck. Then they're moving on with their war chest to countries that are slightly bigger. Italy's a good one. They're eventually going to move into France. France will be probably, after Italy is taken out, the next country that the hedge funds work to destroy.
Italy is it. That's the end of it. And this is something that we've been predicting for quite a long time. Many of our guests have said Italy is the most vulnerable. Basically, all of their banks are bankrupt, including Monte dei Paschi.
Monte dei Paschi, the oldest bank in the world, been bankrupt for 300 years. But Italy does have 2,500 tons of gold, something in that, along those magnitudes. It puts them in the top 5 biggest gold holders in the world. So they are positioned to withstand this revision of all derivatives of the world against gold. Gold goes to $5,000, $10,000, $15,000 an ounce. All fiat money goes to,
I'll talk about the Italian bank shares. I think technically, basically that's Deutsche Bank up at the top right there. Is not quite as bad as Lehman Brothers yet. This is when Lehman Brothers went bust. I think all the Italian banks are down here somewhere. I think they're beyond bust. I think they've actually gone past a bust event horizon. But they say the share price of banks crashed for a second trading day last week, with Intesa San Paolo off 12.5% and falls of 12% for Banca Monte dei Paschi, 10.4% for Mediobanca, and 8% for Unicredit. These lenders have lost a third of their value since Britain's referendum.
Right. The ECB, run by Mario Draghi, an Italian fellow, they've been buying up their bonds on the open market like gangbusters to try to forestall the inevitable. It's our time now to talk with Rob Kirby of Kirby Analytics. Rob, let's talk about derivatives. The last we spoke, J.P. Morgan had the biggest derivatives book in the world. Now it's Deutsche Bank. Their share price is tanking, just like Lehman's before their collapse. What are your thoughts?
Well, my thoughts are, first and foremost, Deutsche Bank answers to a different regulatory regime than J.P. Morgan. Deutsche Bank is subject to German regulators, specifically an organization called BaFin. And BaFin is extremely aggressive and independent of political or intrusion, whereas J.P. Morgan is overseen basically by the U.S. Federal Reserve and the Office of the Comptroller of the Currency in America. So you've got two completely different regimes overseeing the regulatory aspects of what those two banks do. And let's just say it's my belief that the German regulators are a lot tougher on their banks than American regulators are on American banks.
So BaFin, you're saying, is a regulatory arbitrage here? How do they stack up against these other regulators?
Well, BaFin, I think, actually imposes rational economic law on German banks, whereas the Fed, in cahoots with the Treasury, are more concerned about propagating. How
do they let them get such a big derivatives book, though, if they're so sticky over there at BaFin? I mean, this Deutsche Bank apparently has like 100 trillion or more in derivatives. It looks pretty dire.
Max, nobody's talked about derivatives. Nobody will have an honest discussion about derivatives and why derivatives books ever got to be the size they are. 80% of all outstanding derivatives are interest rate contracts, specifically interest rate swaps. There's a longer dated swap, which is called an interest rate swap, and there's a shorter dated version of it called an FRA, or a forward or future rate agreement.
Let me jump in here for a second. How do credit default swaps and derivatives work in a negative interest rate environment? Because in order to price these things, you need a rate to do like a dividend discount or an interest rate discount model. If rates are negative, how do you price these things?
I would ask that we please don't confuse credit default swaps with interest rate swaps. Interest rate swaps and interest rate swap products are what were used to drive interest rates down to zero. And that was an American-led action propagated by the U.S. Treasury, using the New York Federal Reserve as their broker to disseminate the orders for the interest rate swaps and the forward rate agreements, which made the banks, when they bought these instruments from the U.S. Treasury, it made them captive buyers of U.S. debt. Literally any amount of debt that they chose to issue, they could make the banks captive buyers of it. So this is what caused the big push on U.S. interest rates from 3% to basically zero. But something happened round about 2011 in the second quarter. That's when J.P. Morgan's book topped out in size at around 79 trillion in notional. And since then, the latest numbers we have are Q4 of 2015, and Morgan's book has collapsed down to 50 trillion outstanding in notional. 50 trillion is still a big number, but it's almost 30 trillion lower than the peak. And outstanding aggregates of derivatives held by U.S. banks, I call them the Magnificent Five, and that would be J.P. Morgan, Citi, Bank of America, Morgan Stanley, and Goldman Sachs. In aggregate, back in 2011, if you put all their derivatives together, they were about 336 trillion amongst those five institutions. Today, that number, or as of the end of Q4 2015, that number had collapsed down to about 223 trillion. So,
let's talk about that trend for a second, because is that the deflationary drag?
What's occurred is the baton has been passed. The American Treasury has stopped using the derivatives to force rates down, and instead the baton has been passed to Mr. Abe and to Mr. Draghi, who are now doing direct purchases and forcing European debt and Japanese debt down. And what that did is it effectively flipped the table, and it made America now the highest yielding currency basically in the Western world. And in a world where everybody is starved for yield, pension funds, the insurance industry, they're obligated to buy sovereign debt. And when America has the highest yielding debt basically in the world right now, it's a natural for people to go to American bonds, and that's exactly what has happened. But this was all done by design. This did not happen by accident. And it's literally a game of, it's the game of competitive devaluations. I mean, it's bugger thy neighbor, I'll drive my currency down, and they're playing games in the bond market, of course.
Rob, this has been quite illuminating. So in other words, the global banking system basically works together. The foreign banks pick up the baton, as you say, to lower interest rates or to pick up that quantitative easing ball, if you will. The derivatives market in the U.S. is shrinking, but it's been picked up elsewhere.
Yeah.
And it's still very much a controlled market, or I guess you could say it's a rigged market to some degree. Is there an end game? Is there a point where the games fail?
Yes, the games will fail. Negative interest rates do not have positive outcomes, and full stop.
Okay, so talk a little bit about that.
Well, when you make interest rates negative, you're destroying the value of capital.
Canada's thinking about negative interest rates, but what are your thoughts?
My thoughts are there will be very negative rebukes if we get to the point.
How would that play out here in Canada?
How would that...
politically or socially? Or?
Politically and socially, I believe. I think that people who have money in banks, I think it causes a run on banks to begin with. People are going to pull their money out of banks if they're getting a negative rate, as opposed to zero or a very, very...
But this country sold all their gold, for one thing. What was that? I mean, that seems ludicrous.
Well, very interesting story there, because I actually was invited to a private dinner back in 2006, and the man who was the keynote speaker was Jean Chrétien, who was a former Prime Minister of Canada and a former Finance Minister of Canada. And after this dinner, he did a Q&A, and I stood up and I asked him if he could give me some background and some feedback on when he, as finance minister, sold about 350 metric tons of Canada's sovereign gold. And I've never seen a politician do the backstroke quicker than this man after I asked him that question. And he said in his broken English, that was a long time ago and I don't remember that at all. Yeah, well, there are some people that say he can speak 3 languages and...
lies, and more lies.
Yeah.
And so they dumped all their gold. That's ill-advised, especially in a world of negative interest rates.
Yeah.
And so going forward, I mean, let's get into the housing market here in Canada. It's one of the most remarkable property markets at the moment. Prices rising 30% in parts of Vancouver, 15% annually in Toronto. What's going on? Yeah.
And right now people are overdosing on cheap money.
In other cities where they are feeding money to the speculators, housing has become out of reach for most people, most working people. Is that also happening here in Canada?
Yes, absolutely. The heads of banks in Canada, the politicians, and even the governor of the Bank of Canada saying that they've got to do something about the state of real estate in Canada because the prices are spiraling. And when you give people free money, people will make poor asset allocation decisions, and that's exactly what people are doing. I mean, Max, a house is a depreciating asset. And, you know, the notion that the price of a home just goes up 10% every year or 12% every year just because it's there is absolutely ridiculous, and it doesn't even, it's not sustainable. It just isn't.
Yeah, I mean, certainly in places like Vancouver, it's a lot of foreign money coming in.
Yeah.
And I mean, so I'm just curious because this bubble is played out in different countries around the world, in the U.S., in Britain, in Canada, around Europe, and it kind of mixes with the local culture to some degree, and plays out differently. So here in Canada, what's the feeling on the ground here? What the average Canadian? How do they react to all this?
Well, most people, I think, feel it's a train that has left the station. A lot of people who are young feel that the train has left the station and they're just not on the train.
So the fear of missing out, FOMO, as it's called,
has
taken grip. That they missed the property ladder, they've missed their chance at getting involved, and they have no memory of any downturns or reversals or any other market than this one-way market.
Absolutely.
And now when that reverses, as we know it will, this whole generation is going to be left extremely vulnerable.
Well, the ones that bought, have bought in at the top or have bought in at these levels, in my view, are going to very likely be screwed.
Negative equity. All right, Rob, we got to go. Thanks so much for being on the Keiser Report.
Pleasure.
All righty.